So what triggers an IRS audit and how can you protect yourself from one? A lot of people think that they will be audited if they simply try to reduce their tax bill, but that is not true at all. The IRS specifically states that you have the right to reduce, avoid, or minimize your taxes by legitimate means. But what is not legitimate is concealing or misrepresenting information on your tax return. If you lie about deductions on your return, cheat tax rules, hide income, or intentionally report false information, you could be committing tax evasion. And tax evasion is serious. It can result in huge penalties, fines, and even jail time. But still, sometimes there are honest mistakes that you can make that can trigger an audit if you are unaware of those triggers. And in this video, you are going to learn those triggers and, more importantly, how you can protect yourself. My name is Sherman, the CPA, and I help high-income individuals reduce their taxes at mycpacoach.com. Or as the IRS puts it, I help people shape and pre-plan events to reduce their taxes within the parameters of the tax law. Whenever my clients are considering various tax strategies, I always evaluate audit risk and coach them on defense. If the IRS asks you about it, what is going to be your position? How will you defend it? Is it in compliance with the tax rules? Will you have documentation? Will it raise an eyebrow? And ultimately, is it worth it? And so on. And when we eventually file the tax return, we have confidence and peace of mind when that return is filed. And it is hard to feel that way when you are always worried about IRS audits. So let's talk about IRS audit triggers and how you can avoid them so you can feel good about your next tax return. All right, first, you must understand IRS algorithms for audits. The IRS uses computer programs that easily identify when errors exist in tax returns, whether it is missing income or overstated tax deductions. Because they process millions of returns every year, they are able to study and analyze commonalities across tax returns. Every tax return is scored by something called DIF, Discriminant Function System. In short, the higher your DIF score is, the more likely you are to be audited. Now, this computer-generated system rates the potential for underreported income on a tax return based on past IRS experience with similar returns. The IRS analyzes every line item on your tax return and compares it against other taxpayers who are highly similar to you. Then, if large discrepancies exist between you and what the IRS believes is common, then your audit risk may increase. So let's talk about the things that may increase your audit risk, and then we will talk about how you can protect yourself. Audit risk number one, high income. It is true, the more income you earn, the more likely you are to be audited. In general, most people have less than a 1% chance of being audited, but that can be as high as almost 9% depending on your income. And some politicians have called for the audit rate to be even higher for those who earn over $400,000 per year in income. So if you earn high income, you should just be aware that you are a target for IRS audits by default. Therefore, you should make sure that any position you take on your tax return is 100% within the parameters of the tax law. And if so, then you should have nothing to worry about. Audit risk number two, high deduction to income ratio. The more deductions you take in relation to your income, the more likely you are to be audited. For example, if you earn $500,000 in income and have $500,000 in tax deductions, you would have $0 in taxable income, which is fine if that is normal for other taxpayers that are similar to you. But if it is not, then it may increase your audit risk. Now, does that mean that you should take less tax deductions? No. If they are legit tax deductions, then you can and probably should write them off. However, you should be aware that this increases your audit risk and therefore should maintain proper documentation to defend yourself in the event that the IRS questions any deduction you take on your return. Audit risk number 3, underreporting income. If you fail to report income, you will increase your likelihood of being audited. So obviously you want to report all of the income you receive, right? Well, sometimes people think that they can get away with not reporting all of their income. They choose not to report a 1099, a W-2, or some other tax form that they receive. But little do they know that the IRS is already aware of that income. Anyone who pays you more than $600 is required to report it to the IRS. So when you receive a tax document in the mail, chances are that the IRS received it as well. Therefore, if you fail to report income on your tax return, you are only increasing your risk for an audit. Audit risk number 4, dealing with cash. Want to know what is hard to report to the IRS? Cash. Therefore, naturally, professions that deal heavily in cash transactions typically have higher audit risk. For example, bartenders and servers tend to underreport tips and other cash income, so the IRS may audit them at higher rates. The IRS even provides tax credits to encourage employers to report tip compensation just to make sure that Uncle Sam gets his cut of the pie. So if you deal heavily with cash, just be aware of this audit risk. And if you don't have to deal with cash, then I strongly recommend using electronic forms of payment. Audit risk number 5, not filing your tax return correctly. Making math errors or incorrectly reporting information on your tax return can reduce your audit risk. It can be as simple as checking the wrong box on your return, providing the wrong name, or miscalculating a tax deduction. But regardless of what the error is, the more errors that exist on your return, the more likely you are to be audited. Keep in mind that the IRS has history of all of the tax returns you have filed with them in the past. And if you report information that is inconsistent with your prior tax years, then they may decide to audit multiple years of tax returns, which is not a fun process. So to avoid this, try to file your tax returns correctly and consistently every single year. Double check your tax return regardless of who you are using to file it, because it is ultimately you who will have to answer for it if the IRS has questions on your return. Audit risk number 6, not filing your tax return on time. When you fail to file your tax return on time, you increase your chances of an IRS audit. The IRS knows that a lot of people don't file their taxes because they don't want to pay their taxes. And those people may be more likely to commit tax evasion or make errors when they actually do file their tax return. So to avoid your tax return being filed with this group, always try to file your return on time. Audit risk number 7, operating as a heavily audited entity. When you are self-employed, your entity matters for tax purposes. Not only can the wrong entity cost you more money in taxes, but it can also increase your audit rate. If you operate as a sole proprietor or single member LLC, then you are 2 to 3 times more likely to be audited than S corporations and C corporations. But does this mean you should not be a sole proprietor or single member LLC? No, but you should be aware of this, and you may want to reevaluate your entity to make sure you are operating in the best manner possible for taxes. But now that you understand the most common risk of an audit, let's talk about how you can protect yourself from one. All right, so there are 2 main ways you can protect yourself from an audit. Number 1, maintain proper documentation. You should have documentation to support any information you report on your tax return. That way, if the IRS ever questions it, you can provide it to them and go about your day. If your return is selected for an audit, they normally start by requesting more information about something you reported on your tax return. And if you provide more information and satisfy their request, then you would have mitigated any risk of more taxes, penalties, or other issues associated with a full audit. So always remember, documentation is your best defense in the event of an audit. And if you don't know what type of documentation to keep, drop a comment below and I will make a full video on it. Number 2, tell the truth. Never lie on your tax return. If you make a mistake and the IRS catches it, Just correct it and keep moving forward. But don't lie to support something that is incorrect on your tax return. That will be fraud, and fraud could result in you being put behind bars. If you don't know what fraud is, just know that fraud is intentional misrepresentation. If the IRS believes you are intentionally lying on your tax return to pay less taxes, you can find yourself in much bigger trouble than simply paying the amount of taxes you owe. So be honest, maintain documentation, and if you want to reduce your taxes, do it legally with the 70,000 pages of tax code that already exist. And if you want to learn more ways to do that, then be sure to subscribe to our channel. Thank you for watching, and I look forward to seeing you in the next episode.